Good morning, everyone. Welcome into our Capstone Coffee Conversation. Today is Tuesday, May 14th. I'm your host, Brian Felshaw. I'm joined here by the wonderful Ryan Skogstad. And we're going to be doing a little interview today, talking about a topic that we have not discussed before, private market investments. We've been trying to talk about some things that we are a little bit non-traditional that we haven't talked about before. Last month we did crypto. This month we're going to talk about private equity, private lending, private real estate, that kind of thing today. So thank you for joining. As always, if you have questions, feel free to put them in the chat box there in Zoom, and we'll save time at the end if there's any. So let's go ahead and dive in, Ryan. So why don't we start, just set the table for us from a 30,000-foot view, talk about private markets and how they kind of fit into the general investment landscape.
Good. Thanks, Brian. The way that people are able to invest has changed a lot over the last few decades. If you think about how people bought a bond or a stock even 20 to 30 years ago, it's a lot different than we do it today. Today we have access at our fingertips to buy and sell in the public markets, stocks or bonds. Very quickly, you can get into an investment in seconds. You can get into a whole portfolio in seconds. And then likewise, you can also take away an investment. You can sell an investment in seconds and remove all of your portfolio and go to cash in seconds as well. So that technology has really advanced in the accessibility and ability to trade in and out of stocks or bonds or portfolios. Back in the prior decades, if you were buying or selling a stock or a bond or a mutual fund, most of the time you had to go through an advisor and you kind of had to pay a big commission to do so. Mutual funds would charge like 6% upfront commission. A stock would charge 5 or 6%. Bonds had a lot of what they call grease in them when you buy an individual bond or a bond portfolio. And so they're somewhat costly to get into, which led investors to think this was a long-term position. And they would hold those stocks or bonds because they're kind of expensive to get into, or you'd have to mail the company directly and do a direct share, so you put a stamp on a letter and throw it in the mail and you don't stock for a few days. And so buying, selling previously was a much more cumbersome, but more of a long-term buy and hold strategy where you're an investor. Today, sometimes if people are left to their own devices, it can feel a little bit more like trading rather than investing.
Yeah, it seems like technology has kind of greased those wheels a little bit, right? Made it easier to and more efficient, but sometimes that can work against us, right?
Absolutely. Yeah. Yeah. And I think what we're talking about today, the private investments is a little bit of a reversion back to a little bit of how we used to invest, where it was a little bit longer term strategy for a few different purposes.
Yeah, so let's stay on that. So talk about a little bit how private funds, sometimes called interval funds, how do they work and how does that force us to be more long-term investors?
Okay. Yeah, so the private investment can be made up of things just like a mutual fund or an ETF or an exchange traded fund. Just like a mutual fund, you can buy a basket of stuff, right? You can buy a basket of private stocks instead of public stocks, right? You can buy a basket of private bonds. You can buy a basket of private real estate. So it's made up of some of the same types of components or same types of baskets, but instead of buying public stocks, bonds, mutual funds, etc., that are tradable, like I said, instantly, the private market, same type of asset classes, but they're now not traded on an exchange daily. Right, so the components are the same type of stuff, but now private markets. They offer different entry and exit points, right? So instead of having a mutual fund or an exchange traded fund, publicly traded stock or bond that you can get into or out of at any time, a interval or a private investment has entry points and exit points. And sometimes those exit points might be quarterly. Even you might have to even have like a year lockup in certain types. So some of those, they do have a little more restrictions from the public markets, but they are made up of, just like mutual funds or what have you, made up of baskets of whatever type of asset class you're looking for.
Is that kind of what it looks like on a statement too? If a client isn't just a line item mutual fund?
It would look just like a mutual fund. It'd have a name there. It'd tell you kind of, the name's a little bit of a descriptor, comes with a ticker as well. So you can see that just like a publicly traded fund or ETF, but now it's just held privately.
And you can sell out of them in different literal intervals. That's why they're called intervals. So you mentioned quarterly. That might be a little bit of a change from what we're used to, where we can just at basically any minute of any day, we can push sell and the next day, or if it's during market hours, we can get out of something. But quarterly actually is an improvement, right? I mean, if you were to invest in a private company in decades past, you would have to find a specific buyer. That may take way longer than quarterly. So it's actually, things are getting more efficient.
They are, right. There used to be, we've kind of all become aware of private REITs where you were locked up for even 7 years and some of those types of things, right? So those are a little bit how you could have done that a decade or two ago. But nowadays the private funds, usually a quarterly entry or exit point. And sometimes though they do have some restrictions. Sometimes if too many people are trying to take their funds out, they do have some restrictions on how much of your sell order you can get on that quarterly basis. So it does create some types of complexity there to be aware of, but you still do have some periodic times where you're able to sell and move on.
Right. So that begs the next question: who are these good for? Why should we invest in interval funds?
Yeah, I think the first off, you do have to have a certain amount of assets in your account to be able to use them. It is for kind of higher net worth accredited investors. I think when you're just getting started and you're starting to put an account and you're growing your accounts, the public markets kind of give you everything that you need as you're kind of building and growing. So I'd say first off, it's for somebody that is looking for a little bit broader diversification. Their portfolio has grown, and now the public markets maybe provide most of or the majority of that diversification, but having access to some other areas that the public markets don't service for somebody later, the kind of more mature portfolio would be first off and foremost where I look. Institutions, endowments, foundations, pension plans, they've been using these private types of funds for years. They're just becoming a little bit more accessible today to the average retail investor as there's become just more proliferation. The fee structures have come down, the access and exit points have become a little bit more repeatable. And so the institutions have been using these for a long time because their investment time horizon is typically much longer than the average individual, right? The average pension is going to be here for before we started our investment career and past our passing. So the institutions have been using them, but now we're starting to incorporate them, or at least look at incorporating those into some individual type of portfolios. I think the benefit also is just the fact that we can now have access to a much broader array of investments. Most people aren't aware, but the private stock market actually is much larger than the public stock market. So if you're going to buy something, S&P 500 related or small cap or international, you actually are very limited in how many companies to choose from, rather than if you buy a private company, right? Many more companies are private today than public companies. On the fixed income side, not as much. The bond market, the public bond market is pretty large, but there's types of bonds that you cannot get in the public bond market, all right? And so it gives us access to a broader array of companies or, private stocks, or a more specific type of bond, and also real estate. There's a lot of REITs that are publicly traded, but many real estate portfolios are held privately, and it gives us access to some of those things that I think that are helpful. And so that's a good diversifier for people if they already have a good, stable public stock bond portfolio.
Yeah, that makes sense. So from a strategic perspective, what are some of the pros and cons of those private investments that someone should weigh?
Okay. Yeah, I think first off, the biggest pro is that you get diversification, added diversification. The whole idea of trying to make sure that we don't outlast our money, or that our market or our portfolio doesn't have big swings due to the market is we want some diversification into private markets. And so that's the number one, I guess, benefit is just added diversification. We were talking about technology and how you can buy and sell stocks, portfolios very quickly. So if you only hold public stock or bond, your portfolio sometimes will move around based on the perception or the mentality of the public. If everybody's buying, well, then things are going up. If everybody's selling, things are going down. But that can happen very quickly, and volatility can be extremely increased with only public traded stocks or bonds. When you hold something privately, very difficult to go and sell a private company immediately, right? Or to start one up. Right? So buying and selling, the process is much longer, it's more strategic, and same thing with real estate. People aren't running and putting for sale signs in their yard because the market goes up and they're not, taking them down or what have you. It's much more of a thought out kind of long-term investment process in the private markets. And so that can help reduce volatility because you don't see the big swings that the public markets can see, right? So those are kind of a couple of the big pros. Returns can be pretty good in some of these private funds, right? There's fixed income pieces that we can get to that today are actually at really good high rates. Some private stocks can do really well when maybe public stocks are not. So returns can be pretty healthy. Volatility, a little bit more predictable, a little bit less. And then just diversification. I think those are the major pros. And then on the flip side, some of the negatives I would say is it is difficult to exit, right? So sometimes you have to wait for a period of time, and sometimes you might not even be able to get 100% of funds back. So there can be in selling, so you definitely want to make sure any portion that you put in some type of investment like this is a measured amount where you're not needing a certain amount of those dollars on a consistent basis. And then they do have a little bit of extra fees that the public market doesn't. When you're buying and selling a private company or bond, it's not as easy as clicking a mouse. And so the institutions that run them have a little bit higher expense ratio than just buying and selling Apple or Microsoft or an ETF.
Right, that makes a lot of sense. On the liquidity side, I kind of picture, when you're at the airport, everyone's trying to get through the one door at the same time. It can take a long time to filter everybody out. So that, on the con side, maybe just being aware of, okay, this portion of my portfolio is going to be non-correlated to the rest of the market. It can be resilient to hard times, or maybe it's going to be it's going to do really well for me, but I'm going to plan because it's going to be harder to get out of it because it's not the click of the mouse, like you said.
Yeah.
Okay, let's pause there. I think, do we have some questions, Moesha, to go over?
I have two so far. The first one is, how does Blue Rock Total Income and Real Estate Fund differ from an interval fund?
I think we had them on, right?
We have had them on. They're exactly the same. That's exactly what it is. Yep. So if you are in the Blue Rock, or you've seen that position, that is a privately held real estate fund. And that's a good example of something that is a good diversifier. In 2022, private real estate did very well. Everything else, public markets, bonds, stocks, REITs, everything was down substantially in 2022. But privately held real estate, and that fund being one of those, did extremely well. So that was a great year to hold some of that. On the flip side, last year, the public markets did just fine. Public stocks did very well last year. Bonds did just fine last year. And so far this year, they've done well. But private real estate with high interest rates has had a slight negative over the last year to 15 months. So that's part of that diversification piece. Sometimes, we want to see every investment in our portfolio go up. But the difficulty is if everything's going up together, then sometimes everything can go down together. Yeah. And part of having diversified portfolios, you have things moving at different times in different directions, and that helps smooth out the ride. So maybe the tops don't get as high, but also it keeps hopefully some of that the bottom's not as low as well.
Yeah.
How are they regulated?
So they have to pass the same SEC. Any investment that regular everyday people can buy has to pass SEC requirements. They have to file their same requirements that a publicly traded stock has to file. Everybody has to meet those same restrictions and those same requirements to sign up to have everyday clients be able to invest in them. Beyond that, I'll defer to Ryan.
Yeah.
Anything else on that?
I think there is a little bit of, you do have to get in, the managers that are picking the private stocks or bonds have to do a little bit more legwork. A lot of the public companies have to come out, and you can do your own research on Google of a publicly traded stock and see what their last sales were for last quarter, and what their revenue was and what their expenses were. It's much more difficult on a private company. You do have to get in and do your own sleuthing, which is why sometimes, again, that fee structure can be increased a little bit for the institutions that are running the private stock or bond or real estate funds, because there is more legwork. Same regulations as far as being able to come to market, but they aren't. The information is not as readily available, I guess, and so it does take a little bit more work to make sure that you're in a good spot.
And sometimes, not all interval funds, but sometimes there may be an extra form that you as a client has to sign that has certain disclosures, usually talking about that liquidity that we talked about, that we can sell quarterly. And even then it's a pro rata share if everyone's selling at the same time. So sometimes there's an extra form that's required by a client to be able to buy that from you as well.
Another one is, are you talking about investing in private companies that other investors wouldn't have access to?
Other investors have access to them as well, right? So it is, it's companies that are just not traded on the stock exchange, but other firms, institutions, pensions are already investing in these types of companies. So we're not going down to the local laundromat, around the block and asking to take some ownership in those types of companies. These are still big companies that and see and use every day, but they are private companies not traded on the stock exchange. And a lot of companies today are not going to the stock exchange. They're not going to the public market like they used to. That kind of was the goal back in the past, was to become a public company. Today, a lot of companies like to keep control of how their company is run, and they don't want to answer to shareholders. So we're seeing a lot of companies today that stay private longer, still do very well, see, touch them every day, but they aren't traded on the stock exchange. So it's not like something that is really obscure, or that is, we're kind of taking a flyer. These are things that are invested by large institutions and pensions already. We just have a little bit better accessibility that is coming to market over the last 3 to 5 years. So they're starting to enter some conversations. It's definitely not anything that we're rushing into or trying to proliferate in everybody's portfolio. But we just thought it'd be something to be aware of as we move forward, that there is better access to some of these areas of the market, so we haven't had in the past, but they've been used by the biggest types of investment companies for a long time.
Yeah, I think of these as very, very specific tools in our collective tool belt, that given the right situation or the right need, we can bring to you, excuse me, as a recommendation, but not always.
And they wanted to follow up with a question so these aren't startup companies.
Correct. They are not startup companies. Even to become a private tradable company on the private market, you have to have quite a bit of revenue over a period of time. So it's not a startup type of endeavor. These have, again, been companies, and other people and institutions are vetting out the quality of each of these types and what makes sense and what not make sense to put in that portfolio. And it's a big basket of companies that, again, and see every day, but they're just privately held, not publicly traded.
I think venture capital might be kind of what you're thinking. That's more angel investors, Shark Tank, that kind of thing. These are more companies that are established. They're just not publicly traded. Yeah.
And last question, can private equity investments fail and go to zero?
I'll take that one. So similar to the risk of any type of investment, right? There are companies out there that can struggle at times if they fall in hard times. But what I think about in terms of risk with this type of thing is we would be buying a fund. right? In a fund, you're gonna have hundreds of companies potentially to help diversify within the fund so that if one struggles, they don't bring down the whole fund, similar to an S&P 500 fund. On top of that, there are also different risk levels within different interval funds and private equity or private lending funds that are similar to different types of publicly traded funds that have different risk levels within them as well. You can invest in smaller technology or older energy companies, right? There can be different risks to those. Same thing with the private markets. It could be a private fund that invests in bigger, more established, late stage companies that could get acquired by a bigger company in the future. So I think it depends on the objective of the fund, what kind of risk you're taking there. And similar to any other investment, there can be some that struggle and there can be some that do really well. But in a fund, collectively over time, like Ryan talked about at the beginning, those are going to provide value and hopefully grow over time, but just not be correlated to the rest of the market. Yeah.
Just remember too, every public company that's traded today started off as a private company, right? So these are, same types of companies, just maybe not haven't gone to the public market. But.
Yeah. That's everything. Okay. Well, thank you for joining us. As always, if you have questions, reach out to your advisor. We're grateful for you to join us today, and we'll see you next month.
Thank you.